Tempered enthusiasm amongst investors has no doubt put some life back into the stock market this year. Despite the war on inflation continuing and higher rates, the economy here has been pretty resilient here as well as in the US. But will it last? And how should investors be positioning their portfolio? Joining me with her thoughts is Diana Avigdor. Diana is a portfolio manager and head of trading at Barometer Capital Management. Diana, welcome. Great to have you on.
For having me. Hi, Saijal.
So, how would you describe the markets?
Oh, I would describe the markets as conflicted. And there is an equal amount of negative headlines as there is positive headlines. But the market is a forward-looking pricing mechanism. And we're off our lows quite substantially. Back in October of 2022, the market was down about over 25%. So we've seen lows that have now been months since. And as a forward-looking pricing mechanism, a lot has been priced in. We have been waiting for a recession and pricing in the recession for over a year now.
Yeah, let's talk about the forward-looking mechanism. We have a chart that you provided. Walk us through this and what it's showing us. I know there's a lot of detail there, so if you can just kind of highlight what we're seeing.
What you can see at the big picture over there is that since 1942, I think is there, you see a bear market return in the red, and that's just showing you how much the market can be down due to an event in the bear market. So the low in October, we were off about 27% in the market last year. The 1 year return after lows, you can see that it's very positive in almost all cases, except we don't see this last one in 2022. So my point is twofold. One is market is a forward-looking pricing mechanism. In other words, all the known information that we're now cycling through, it wasn't lost on us last year, and the market has priced all of it in, if not some of it in. And the second thing is that the law of averages is on our side as a result. And so, if you're an investor and you're looking at the headlines and you're thinking, oh my God, how is the market not selling off hard? You have debt ceiling headlines, you have bank financial issue headlines, you have high inflation all over the papers, you have people calling for a recession, hard landing, soft landing, wherever you are on a spectrum. And yet the market's kind of holding in. S&P is up about 6%, a little over 6%, and so is the TSX. NASDAQ is up 15%. How come? That was not supposed to happen. But you do have to take it with last year's return in mind.
Yeah, Diana, so let me just step back then. So is a recession still on the cards? Because it was priced in.
It could be. It could be. And a lot of it has been priced in. And if there's so many different moving parts, and that's why the market is so conflicted. The market, for example, is pricing in about 68 beeps of rate cuts out of the US in the second half of the year. Well, that is actually not a great thing, in my opinion. When the market will not price in cuts, it means the economy is better off, doing better. If they need to cut rates, it's because the economic data is coming in weaker and weaker than expected. So therefore, what we need to see is pricing economic data to come in light, but demand side economic data to come in strong. So non-farm payrolls, for example, last Friday.
It's going to ask, yeah, because it's showing a strong picture still.
Very strong. It's the 13th consecutive beat relative to expectations. So labor markets are holding in. The hourly wages are coming down. So that's the pricing data. We had CPI today out of the US. It's the 10th consecutive drop in monthly inflation. So as long as demand holds and pricing comes down, that could probably work towards a soft landing as opposed to a hard landing. If there is a crisis, there's a hard landing, we'll have to reconsider everything.
Yeah, and obviously, we always know that there are these unknowns, but obviously we are seeing pockets of resilience.